What became quite clear to us early on, restoration of landscapes and markets, they exist in parallel, but they don't connect and let capital flow smoothly for various reasons that prevent scale.
Nature risks means no more turnover, not a sustainability issue, no more turnover. So those who are there start to really look at it as something fundamentally strategic and not only, like something which is good in nature KPI viewed from an ESG kind of standpoint.
In my personal experience of what we've done with TerraGRN, we don't believe regenerative ag on its own right will create the value just because you follow the practices.
Yeah, sure.
It will create value when it is integrated properly into the food value chains and there is an economic pull-through from the buyers. Because we also believe sustainability, if persistently applied with a premium, will never create adoption at scale.
For sure.
And hence this requires the markets to play along with standardized practices, as well as being able to have very strong verification and measurement systems.
When we go to the business model question with our clients, the question they ask is, what's the business model of regenerative agriculture?
Yeah.
And they want to understand it against their business as usual. Truth is, climate risks, they are already there. They are financially, impacting their model today. So if you want to have a proper understanding of what's the business case of Reg Ag, you should compare it against risk-adjusted business as usual, which means that the companies who have quantified their risks physically and financially are much more aware and much more ready to go for this kind of move, and that those that still consider that they look at a business case against business as yesterday. It's not business as yesterday anymore.
These risks are not clearly allocated and priced. No clarity for risk means capital cannot either enter or it becomes very expensive. Impact can create an attraction for capital, but cash flow sustains it. This is very important. Ecosystems are not valued as assets on the balance sheet. What we want to think about is ecosystems have so many services, whether it is water, biodiversity, resilience, but it never finds itself visible, so it's actually invisible to the investors. So we've got to change the way the sector is perceived and how standards and DFIs play a role to drive ecosystem services and its full value.
Sundar, great meeting you here. You're a friend of Blunomy. You're actually doing amazing things with TerraGRN. I have to say that we've been extremely impressed by the entrepreneurial spirit and what you're trying to achieve. Could you please describe to our community, clients and friends what TerraGRN is doing and what you try to achieve?
Thank you, Vincent, for this opportunity. Firstly, for your audience, it's good to explain what TerraGRN is. So TerraGRN is building nature-based value chains that connect degraded landscapes to downstream customer demand or industrial demand for sustainable materials, food, energy, and carbon. We set up TerraGRN in the UK in 2021 with the objective of building a model that created landscape restoration for scale-up integrated into real economies. We began the project in Mpumalanga, South Africa, where there is large amounts of degraded lands, there's strong community structures, and there's a real socioeconomic need. We partnered with the local communities there to access and restore lands, creating employment and long-term capability for the local communities, particularly youth and women. What became quite clear to us early on, and this is very important for any enthusiast in nature-based solutions, is it became very clear to us early on that restoration of landscapes and markets, they exist in parallel, but they don't connect and let capital flow smoothly for various reasons that prevent scale. Let me explain this in more detail. So we observe that landscape restoration is very much funded by grants and carbon finances in most parts of the world. But industrial demand for materials, food, and other products is still finding it difficult to secure traceable, reliable supply. Hence, we say that these two are working in parallel, but they don't connect. And we find that capital is in the middle of that, but capital doesn't flow efficiently, connecting the two. So the TerraGRN idea was always that we bring these two together into one system. So we look at landscape restoration through biodiverse agroforestry systems, tailored or designed to local conditions with multi-species from the local region, and ensuring that that is backed by downstream offtakes and linking that to downstream market spaces. This is an important aspect to how we have structured it, because the way we look at agroforestry systems, we believe that they create multiple revenue streams that is far more critical to create a continuous flow of cash flow in order to make it an infrastructure play on nature as opposed to a project. We know that there are various models in the marketplace. Sometimes people look at it as carbon financing, where carbon becomes the primary revenue driver. But in our case, we have taken a different approach. We have looked at this as a nature infrastructure. Our initial cash flow, near-term cash flow, comes from clearing of invasive biomass like pine and eucalyptus, which helps with landscape restoration. And at the same time, it creates energy and timber product revenues. As the system matures, we can move towards higher value, higher margin products such as bamboo engineered boards, activated carbon, and similar bio-based products. So we are seeing a continuous revenue system where initial revenues come from invasive biomass, followed by medium-term material solutions, and finally carbon becomes long-term value. So what we have delivered so far, Vincent, is that we have a 50-hectare pilot that has been very successful. It is measurable impact that we have recorded on soil, on biodiversity, on carbon, and we're now ready for a scale-up.
Fascinating, and that's what we loved with the project that you structure. I think that compared to what we see, the project by itself is much more systemic than a pure carbon, avoidance or carbon reduction kind of business model. And I think that looking at what we see nowadays, it's also much more resilient as a business model by itself. And I think that's what needs to be captured by the market today, is that not thinking only about, saving carbon, but producing real stuff, like, a regenerated soil, like agricultural, food, full food, for instance, like materials, energy pellets that will, replace coal and so on, makes your revenue streams very diversified, your impact extremely positive, and at the end, your business model much more resilient. That's something that would depend on voluntary markets, potential regulations that may change and so on. And that makes something which puts nature as an asset class specifically.
I have a question for you. We are already observing that nature-based topics are moving from being a sustainability discussion into much more a core business decisions, predominantly looking at material value chains, food value chains. So from your own discussions with corporate clients and investors, are you seeing that the narrative is already becoming clear for them, or are there still any form of misconceptions about what is the opportunity and where the value is?
Pretty tough question. Of course, it depends. Regarding the awareness of large corporates, I think it mostly depends on the sectors in which they operate. If you look at agri-food, if you look at cosmetics, if you look at, like luxury for other reasons, these kind of sectors, we see advanced players who have really realized that their whole business depends on nature, relies on nature. Nature risks means no more turnover, not a sustainability issue, no more turnover. So those who are there start to really look at it as something fundamentally strategic, and not only, like something which is good in nature KPI viewed from an ESG kind of standpoint. Now, if we look more broadly, I have to say that I've been pretty surprised in the last months to see quite a lot of executives still thinking that we're going to solve the energy or the carbon problem only with machines. And truth is, it doesn't work. You need to look at, nature-based solutions per se, because it's systemic. It's not only about carbon. It's carbon, it's water, it's land, it's pollution, it's everything that you can treat all together. And this kind of positive economy based on nature life solutions is still new for quite a lot of players. The awareness is still not there. Now, if I go to the kind of misunderstandings that we see, moving the conversation from a sustainability topic to a highly strategic and financial topic. First, I think there's still a need of awareness that we are not talking about something that is an option. It's like purely planetary boundaries. It just doesn't work anymore if we don't solve this issue at some point. The second thing is, when we go to the business model question with our clients, the question they ask is, what's the business model of regenerative agriculture?
Yeah.
And they want to understand it against their business as usual.
Correct.
But that's a mistake, because truth is, climate risks, they are already there. They are financially, impacting their model today. So if you want to have a proper understanding of what's the business case of RegAg, you should compare it against risk-adjusted business as usual. Which means that the companies who have quantified their risks physically and financially are much more aware and much more ready to go for this kind of move, and supply chain reintegration, long-term contracts and offtakes and so on, that those that still consider that they look at a business case against business as yesterday. It's not business as yesterday anymore. Now, once you've said that, I think one of the key issue is that it's systemic, and corporates don't necessarily like systemic solutions. You need, silo. You need projects. Pure revenue kind of projects and risk-reward profile and so on. Whereas you're not producing a single product, as we said. You're not, tackling a single impact. Correct. You're doing it as a systemic solution. And based on that, on the business model, how to get, the business case relevant and how it can fly, it also means that you can, look for cooperations between different off-takers from different supply chains. Correct. But each of them will have a very strong interest in getting your material, your energy feedstock, your carbon avoided, and your food, that you can produce. And that's cooperation. And that's hard, I think. So they really need to understand why they're. And we didn't talk about finance, but truth is, and it now better than we do, allocating capital to this kind of projects means also something a bit innovative. You need to find some catalytic funding. You need to prove that there are different kind of revenues, and co-financing is actually the key thing. Of course, with patient capital. I think that's the most critical things we see. And of course, education, proof of impact, curiosity, and so on is also things that the market needs.
So I want to pick up on that particular point you just make about capital. But from our own experience, what we feel is that as a starting step for any of these conversations, we have concluded that constraint is not capital, but what we call it as constraint is translation. It's the translation of what nature is in a simple enough way for investors to understand, price, and invest in. And that's why capital is held up, because they don't understand how to price a project versus an infrastructure, because risk materially changes.
True.
And from our perspective, when we look at this as a problem, we clearly see that we have to answer this in specific ways. The first requirement for any infrastructure initiative like nature is revenue visibility.
Yes.
And ideally, we would want predictive, contracted, or at least a clear pathway towards cash flows, ideally diversified, not just one pathway like carbon.
Yeah.
The second thing you mentioned is very important, which is risk. In nature-based solutions, you have biological risk, you have policy risk, you have market risk. But what we have always noticed is that these risks are not clearly allocated and priced.
Of course.
No clarity for risk means capital cannot either enter or it becomes very expensive. And then the third thing that we found was a very important requirement is structuring it properly. I'm going to pick up on something you mentioned because that is the heart of the matter. Nature-based solutions are still treated as projects by corporates and investors. In fact, it is already shifted towards nature-based systems that have to generate revenue. No longer impact is funded. Systems need to generate income. Impact can create an attraction for capital, but cash flow sustains it. This is very important. So when we look at it from that perspective, we have noticed two fundamental shifts. We have noticed that investors are able to fund when the complexity is simplified for them in order for them to find a better understanding of risk and the ability to invest. Regenerative ag follows the same pathway. In my personal experience of what we've done with TerraGRN, we don't believe regenerative ag on its own right will create the value just because you follow the practices.
Yeah, sure.
It will create value when it is integrated properly into the food value chains and there is an economic pull-through from the buyers.
Yeah.
And that requires courage from the buyers to step away from their traditional practices towards wanting to make sustainability work without a premium. Because we also believe sustainability, if persistently applied with a premium, will never create adoption at scale.
For sure.
And hence this requires the markets to play along with standardized practices, as well as being able to have very strong verification and measurement systems.
Sure. But well, back to this pricing question viewed from corporates, it's the whole procurement strategy that you need to think about, meaning that and in the current context, for instance, where you see volatility risks, inflation risks and so on, now they pay a lot.
Correct.
Whereas if you reintegrate a bit your supply chain, go for more long-term contracts with impact and so on, and if your model is not only based on, let's say, agricultural revenues, but energy revenues and so on, you'll diversify the model and you'll make it competitive.
And every off-taker takes a proportion of the risk rather than all of the risk.
Exactly.
And I think that's where, when you look at it as a holistic system and even go back 5 years and start to see the risk has actually lowered over time, but the appetite to enter the market has still not systemically changed. And I believe that in the next 2 to 3 years, we are going to see that shift. But it has to come with three things. It has to be very clear about an understanding of revenues and visibility of that. Risk being clearly articulated and managed properly. And third is making sure that you've got the ability to create structures that allocate risk and allocate the benefit to different off-takers and investors coming in.
Back to things we've done together, maybe one question there. Can you tell us a bit more, based on your real entrepreneurial experience, how you see DFI and public, funding supposed to bring, the kind of guarantees, de-risking mechanisms to get these kind of capex heavy but very long-term, value-driven projects? How does it help? How does it work? Can you tell us a bit more how you've experienced that world?
I think it's a loaded question, but let me start from a place where I mentioned we need to simplify and translate the requirements in a very easy way to consume from a capital perspective. So the work we did with Blunomy in the first 18 months when we started the company was very important, because what we did was we took a concept, what TerraGRN had, and we translated that into a much more acceptable structure by starting with theory of change, impact metrics, then financial modeling, and then value chain economics. Because it gave us a clear line of sight to understanding how can we create a multi-income stream revenue system, and where does margin lie? How do you turn volume to margin? That was important. As we went through that, we realized that the conversations that we were having with commercial institutions as well as DFIs were becoming more philosophical rather than factual, because we were seeing questions about risk. We're able to quantify risk, but the real issues are, it is a stage of maturity that is important. So we were not suitable for DFIs, because they usually like to come in as a second or a third tranche in a structure. Typically, one needs to find catalytic capital upfront. And so ideally, it has to be either a carbon pre-financier, especially in our case where carbon, although is a long-term value, it is also additionality helping us kickstart this project. So getting a catalytic carbon or catalytic equity is critical. Once that falls into place as anchor, then we can start to structure DFIs coming in. It has been quite a challenge bringing DFIs into the discussion, also because DFIs are constantly looking for collateral to back up any investments they put in. And typically, nature-based startups do not have that balance sheet to be able to do this. And I think that is where one of the structural problems of the sector exist. Because if I put forward a thought, which I think a lot of people are talking about now, ecosystems are not valued as assets on the balance sheet.
Of course.
Now, ecosystems, however, because today's systems, they value the ecosystem when you harvest something from it. What an irony. What we want to think about is ecosystems have so many services, whether it is water, biodiversity, resilience, but it never finds itself visible. So it's actually invisible to the investors. So we've got to change the way the sector is perceived and how standards and DFIs play a role to drive ecosystem services and its full value. For someone like TerraGRN, this is an important aspect, because we're not a carbon project who wants to simply value the carbon, or a timber merchant who just wants to value the timber we are producing from the forest. We don't believe, at least in the long term, that valuations will happen on individual products. The values should grow for ecosystems, because ecosystems are complex, but with complexity, you're creating value over time. But today's systems are not in a position to value that. I think that is the disconnect, but we are at that inflection point where people are starting to talk about it.
Very in line with that, and very impressed by your resilience, because it's a kind of a huge challenge to tackle, get people in line with that. And back to the ecosystems not, being valued in balance sheets. I think even, when you extract something from the nature, you don't pay for that.
Yes.
You pay for the extraction cost.
Extraction cost,
you
and
pay
the
for the transformation. But you don't pay for the raw material that nature provides there.
I have a question for you. when you look at your current, you work across small organizations like ours all the way through to corporates. Do you see that in the course of the next decade that we will see scaling up of nature-based solutions or regenerative ag, and what will it take for that to happen?
To be very honest, we're not there yet. It's some leaders, some leading companies, start to put some money at risk, and some have skin in the game, but it's not mainstream, I would say. Two things. First thing is the risk is there. And I think the risk is absolutely fundamental. The more companies will, financially pay the consequences of major disruptions on supply chains, on the demand changing for different reasons, the more they'll consider that the business case of regenerative agriculture is definitely profitable against these risks, adjusted models. So that's, I think, the key point. And then there are some more visionary companies that really start, to change and to be serious about it. Those who do that change their whole supply strategy. They go much closer to their suppliers for traceability, to manage the risks, to make sure they'll get, the raw materials they need, not necessarily at the low price today, but at a fixed price, predictable price in the long term, to get their own business model resilience. They start to collaborate with not necessarily peers in the same sectors, but other companies who have the same interest in getting this, nature at the end expected and delivering the materials they need. I think on the offer side, we also need people like you, like robust developers, people who are there for the long term, who really look at what's happening on the ground year after year, crop after crop, and structure a business model that are resilient, that are not going to change because there's a fire and then there is no carbon anymore, and all what we know in this kind of carbon and nature-based solutions. I think it also means that public authorities need to play their role, giving long-term visibility, supporting this kind of ventures, because it's a social infrastructure as well.
Correct.
It's something that serves the whole society. You could imagine sovereign wealth funds, being invested in this kind of very long-term, but also extremely strategic asset classes. And regarding investors, risks is also the key driver. They start to understand, they've made a lot of climate risks assessments where they see colors. You see, red, yellow, green on different climate risks on all their assets. Now you need to see dollars. And when you start to see dollars, you'll definitely go for much more interest in this kind of RegAg and nature-based solutions. That what we do, and we see them, changing their mind when they see that, reconsidering what profitability and what performance means. And actually, there's also a question of investment time horizon. And definitely we need some more patient and more long-term capital. Returns materialize, but not if you look at it for a 4 years P kind of period. It does materialize with very, respectful and interesting returns if you look at 25 years, for instance. So long-term infrastructure and DFI are definitely key players to partner with. And they are actually the kind of co-financers that corporates are looking for, because they don't want to finance the transformation of their supply chain on their own balance sheets. They can bring contractual agreements, long-term visibility, but they need private capital, and there is solutions there. So we know what needs to change, but you're not waiting for that to change. You're scaling now. Could you tell us what you need for the next stage and your ramp-up strategy?
So no, you're right. So we have successfully delivered the first 50 hectares, and now we're scaling the next phase to 10,000 hectares. That is a massive shift for us on the upstream. We're also building downstream processing capacity in parallel in order for us to turn that volume into margin. while we are also planning the continued development of high margin products, pathways like bamboo for construction material and activated carbon. So we are looking for 5 things as priority for us to get moving on this journey for scale. The first one is making sure that there is operational depth in what we do. And so to do that shift, we have to move from project execution to institutional scale and depth. We have recently partnered strategically with C4 ICRAF in order to bring that science leadership and assurance for us in the upstream. So that creates that institutional depth that we're looking for. The second thing very important for us is blended finance at scale. And hence we are looking for catalytic equity to come in as an anchor. And at the back of that, we expect that there will be concessional debt from a DFI alongside a carbon pre-financier. That creates the structure, but the key theme there is they all need to be looking at the medium to longer term horizon of nature restoration. It's patient capital to bring that ecosystem to. The third thing we are looking at is we currently have a long-term offtake on the invasive biomass that we are already executing upon for revenue. But we now need to find strategic offtake for the bamboo products, and also we're looking at for carbon and food. So these have to come in, and in order for us to bring that in, it requires us to effectively ensure that if the anchor equity investor is also an off-taker, then there is a much better strategic fit. So the choices are going to be important. The fourth thing we require is we need to invest some capital into downstream processing. Ideally, it will hopefully come as a concessional debt from a bank or a financing institution at the back of the offtakes that we are signing up, even if it is modest values. And the final thing is, we require any financier to look at the value of the opportunity, not as an individual product value, but the integrated system value. Because that will change the nature of the conversation towards return, risk, and how capital is deployed over the long term. I think those are the 5 things we're looking for.
Well, very happy to organize the connections with our corporate clients looking for, biosourced energy, materials, carbon and food kind of supply. And of course, I think your testimony and your experience on showing the full value, the full impact and the full returns of what you do could be also extremely valuable to our financial clients.
Thank you, Vincent. This will be very helpful.
Thank you very much.
Yeah.
Talk to you soon.